So today on Toni Talks, I'm going to be joined by attorney Eliot Thomas and our bookkeeping manager, Troy Butler. We're going to be talking about structuring rental real estate. So looking at flipping real estate, rental real estate, and wholesaling. So let's just get into it. So today I want to talk a little bit about structuring rental real estate. That's not just one lane. So, right, there's a multitude of ways that you can invest in and work with real estate. One of which, to start with, is flipping real estate. And if I have a client who comes in and says, I would like to fix up, or I'm engaged in the purchase of fixing and flipping real estate, I'm naturally going to go, okay, well, that's active income. That's going to be subject to self-employment tax. So how can we tackle that? And you're dealing with a lot of third parties, right? You're dealing with contractors, buyers, and people on this site with nail guns. You know? So asset protection becomes a huge thing. So how can I help the client with the taxation of active ordinary income that could be subject to self-employment tax? And how can I help the client with this just bundle of liability?
So the first place my mind goes is you get them set up with a C Corp. That combats the whole issue with self-employment income, gets rid of the 15%. Plus it gives you a layer of protection for you personally, because it's in the corporation's name. If something were to happen, God forbid, it would all be in the corporation's name. They could only come after the corporation's asset. They couldn't come after your personal assets.
So C Corporation, we're going to avoid the self-employment tax, and we're going to pay the tax on the corporate level. That's great. That's a great start. But what if I'm doing multiple projects? I'm not just doing one project. As a matter of fact, right now, I've got 3 projects up in the air, and before the year is up, I plan on doing about 6 or 7 more.
Well, then we're probably going to go with using a limited liability company that is what we call disregarded to the corporation. Put each project in its own individual LLC, limited liability company. That way we help contain any liability exposure. So if there's an accident in unit 1, it doesn't spill over into the other 5. If we didn't do that and we were all underneath the same C Corporation and we have an accident in one of them, well, all 6 are, all of the monies that you've put into the other 5 in that case would be exposed.
Absolutely. Now we have, I don't know, how many projects did I have now? 8, 9, I don't remember what I just said. But now I have multiple projects, and I am actually good at this, and I am making a lot of income, and I am finding it increasingly hard, and it's starting to cost me greatly to take money out of my C Corporation. Because when I do, how am I doing that? How am I taking money out of the C Corporation?
Oh, you're going to have to do it via payroll or as a dividend, which double taxation at that point.
So now I might suggest
a qualified retirement plan, 401k, would be one avenue. All the various corporate deductions allow you reimbursements, your 280A meetings, things of that nature. A lot of different ways. The C Corporation has a myriad of ways to get money out of you at either a reduced cost, if you will, or tax-free.
Well, you're just finishing my sentences now, aren't you? Absolutely. No. QRPs, so solo 401ks, profit sharing plans, those are an awesome tool to be able to defer some of that income. But even further, if we go a step further, what about making an S election?
Yes. Yeah, you can make an S election.
Yes, please.
An S election, and what that will do is that will help us, even at the corporate level, if you pay yourself a W-2 wage, we're still picking up that full amount, that 15.3, because it's our own corporation. Yes, the corporation's paying half, but I, as the employee, am picking up the other half. But if we go with the S corporation, we're able to, I think of an S corporation as having 2 streams of income to its shareholder or officer, and one is in a W-2 wage paycheck. The other is what we call distribution. And both are subject to income tax. We're not going to get around that. But only the wage is subject to that employment tax. And so basically, if you just did half and half, you're basically breaking your employment tax, cutting it in half immediately.
Now, I kind of jumped right into what's the resolution. Okay, but and I did touch on a little bit of what we're trying to resolve, but let's go back a little bit to what the issues are that we're facing. If we say don't use a business entity for our flipping activity. So if we're not using a corporation, S corporation, LLC, we're now flipping on our personal tax return. We're flipping in our personal name. And we already said there is a lot of liability risks in doing so. But then on the tax side as well, you could be deemed as a dealer. Well, what's the big deal?
Well, if you have dealer status, that means when you're selling something such as flipping properties, it's no longer considered a capital asset. It's considered inventory, and it's an ordinary activity as well. So every time you sell a property, you're in the eyes of the IRS, you might be considered as selling inventory. So even if you have a rental property and you sell in a relatively quick point of time, it will be considered inventory, ordinary income. You get hit with your self-employment taxes as well as your ordinary tax bracket, and you don't get the capital gains that you were thinking because the IRS has seen so much of this activity from you, and they give you that dealer status. And we have seen that on multiple occasions where people, 3 years later, they finally come on board as clients, but they had done that on their personal return. And I've seen as many as 10 different transactions turned back to being ordinary income.
And some of the other nasty little side effects of being deemed a dealer by IRS is that you are no longer allowed to take depreciation on real estate. So to your point, if you did have a rental property, even if it be it short term, you wouldn't be able to take the depreciation deduction on the rental real estate. Rental real estate is depreciable, so you're allowed to deduct a portion of the basis of that property over the period of 27 and a half years. That deduction is gone now. You're also not allowed to recognize an installment sale. Any property can be sold on installment. IRS can't tell you can't. But what they can tell you is that you're not allowed to recognize that income over the installment agreement term. You are now forced to recognize that income in year one of the sale. Those are two major pain points, in addition to the being subject to self-employment tax on the sale of those properties, and pulling in even properties in that maybe you had for a short-term period. It wasn't your intent to purchase that property to sell. That is going to also be treated as dealer status and be subject to self-employment tax. Mm-hmm. So when you're flipping real estate, there are some potholes, some things that you want to make sure that you don't fall into, right? Now let's talk a little bit about rentals, because that is something of a different color, right? So now, when you're dealing with real estate, you will learn the word intent very quickly. They love that word. For them, with a lot of things, it's all about your intent. So what you were saying earlier, if you purchase a property with the intent to sell it, it doesn't matter how long you hold it. If you purchased it with the intent to sell it, it is considered inventory and therefore will be treated as ordinary income when you sell it. If you purchase a property with the intent to hold it, now it's going to be treated differently. Now it's a capital asset.
Correct. And that capital asset, as Toni mentioned earlier, now you can take your depreciation and things of that nature, and you do have a lot more to work with. But it is all about the intent, what you walked into. Now, usually the question I hear right away from the client who's trying to think through this, they think, well, how do they know my intent? Well, first of all, do we want to play games with the IRS? But there's no perfect way to document your intent, but they're going to look to it, with the facts and circumstances. So you don't want to play games with trying to say, well, no, that wasn't my intent.
Right. So now that I have purchased a property with the intent to hold it long term and rent it out, it's now a capital asset, it's a business asset, I can now depreciate that property or take an expense for that property over the period of 27 and a half years. That is including your purchase price for the property, which is your basis, and then your improvements that you made to that property is going to be added to your basis if they were improvements that were made prior to you placing it in service or holding it out for rent. Once you've held it out for rent and you start making repairs here and there to the property, now those have to be analyzed to determine whether they have to be added to basis or whether you can take them as a deduction, if one of you guys want to kind of touch on that.
Sure. Typically, if it's less than $2,500, we can just straight deduct it as an expense as a repair.
Mm-hmm.
If it's more than $2,500, then is when we really have to go in and look and see what it was used for.
Mm-hmm.
Things like paint and carpet, you can deduct right away. Things like repairing a roof, repairing a sidewalk, those are all treated differently, and they have different useful lives as well. So these are all things we have to really look at and see what was the repair for, how much it cost you, so on and so forth.
Perfect. So when it comes to rental real estate and whether I can take it as the 2,500 safe harbor de minimis rule, or whether I have to add it to basis. Now, when I say add it to basis, that doesn't necessarily mean that you're going to have to depreciate that expense over the period of 27 and a half years.
Yeah, we can do, which you may have heard of, cost segregation. Cost segregation is one method of depreciation where we actually accelerate. We're not adding any more depreciation. We have our purchase price plus our improvements. That's what we can depreciate, but we can make it faster. So as Troy pointed out, different aspects of your house or your building, those individual components have their own useful life that's depreciable. Well, when it's a cost segregation, we break it up into all their components. Is it 5-year property, 7, 12, 15, what have you? And cost segregation allows us to speed those up. So what was once 5-year property that was being depreciated over 27 and a half years is now sped up to 5 years. You get a lot more deduction for your depreciation right away, and usually the tax benefits therefore.
Absolutely. Cost segregation is definitely a powerful tool.
Mm-hmm.
Even when you're going to now go and sell the property, cost segregation does you some favors because it can take some of those, shorter term assets off of the books, so you're not recognizing all of that recap.
Right.
So
Mm-hmm.
that'll be another segment.
Yeah.
We can do a whole other segment on cost segregation. But when it comes to flipping and rentals, that's one thing I wanted to touch on with you, Troy, because we have a lot of clients. I have a lot of clients who have multiple. They do both, or they're very heavy in one or the other. And it's, do I need to have a bank account for each and every LLC that I'm flipping in? Do I need to have a bank account for each and every rental LLC? Well, we didn't talk about how to structure the rental. So the way that we usually like to structure the rental, and I'll come back to you on the bookkeeping, is we want to have that same liability protection we talked about with the flipping. So we're going to look to your LLC, and we're going to look to the LLC in the state that the property is located in. And maybe if you want to explain a little bit as to why we're going to the state the property is located in versus one of our more favorable states like Wyoming or Nevada.
If we have first of all, an entity that's already formed in there, well, it's already been registered. It has the rights and protections under that state law. So we typically will put that property in that LLC. And as far as its ownership of that LLC, well, then we'll hook it up with a Wyoming holding so that we get that benefit of the extra Wyoming asset protection. And that way you get the best of both worlds. Alternatively, if we didn't, you'd have a foreign Wyoming LLC or whichever state it was being filed in a foreign state, which is, it can be done, but typically it's best just to have one that's there locally.
So if I had a rental in California, say, you would create a California LLC and then have a holding company in Wyoming, correct?
Well,
theoretically, that's the thought. California is a whole other issue. We do California a little bit differently. But typically, yeah, we want to go ahead and have that LLC that we actually have the property in or deeded to in the state the property is located in. Now, in California, they have the franchise tax board fee there, and that's a minimum $800 for every entity that you have registered in California. So when we're flipping or doing real estate or doing rental real estate in California, we kind of look at that a little bit differently. But let's say we have a rental property in Texas. We go ahead and do Texas LLC, and we deed the property into the Texas LLC, and then we would have the Texas LLC owned 100%, so disregarded to our Wyoming LLC for a little further anonymity and asset protection, because we're now bringing the jurisdiction into Wyoming by having the units of that Texas LLC owned by the Wyoming LLC. So that's ideally how we like to have rental real estate structured. If we're looking at a state like California, we might want to look at doing maybe a land trust so that we can do a California land trust and deed the property into our California land trust. And then we can give the beneficial interests of that California land trust to our Wyoming LLC. And that way we're not registering the LLC in California. We just have a trust in California. So we might look at that, or we might look at your specific set of facts and circumstances and how the business or how you're running your business, and do that the simplest, most cost-effective way for you and what works well for your business. But going back, so I have multiple properties that I'm flipping, multiple properties that I'm renting, and like I was saying before, do I need to have a bank account for all of those rental LLCs? Do I need to have a bank account for all of those flip LLCs? And for you guys, remember, all of our flipping LLCs are being disregarded to or owned by our C or S corporation, and all of our rental LLCs are being disregarded to or owned by our Wyoming LLC. So how would we treat that?
So ideally, each LLC would have its own bank account. But I have seen it where just the parent holding company has a bank account, and all the other sub LLCs, let's call them, flow through into the main bank account. And then on the book side of it, you have to make use of classes and locations. So if I need to make sure that I'm tracking each property separately on the books.
So I have one set of books, but I'm classing out each property or LLC.
Correct.
Perfect. So I don't have to pay for 6, 7, 8
sets of QuickBooks or what have you.
Right.
So you can use one set of books. For the easiest way to look at it is per tax return, is how many sets of books you're going to need to have.
Now, if I'm doing that, because I like the idea of classing, because when you have classing, now you have, like you said, one set of books, and you're actually seeing everything kind of side by side. You're seeing all of your LLCs or properties side by side. And then I have, can I call it a master account?
Sure.
Where then I see the net result of everything, for lack of a better term.
Correct. Yeah. So you'll have columns for each separate property. You can see which properties are doing well, which properties aren't doing so well. Maybe you need to refocus your energy on X property versus Y property because Y property is running itself, essentially.
Or maybe it's time for a charitable contribution.
There you go. But yeah, then it will flow through and you'll be able to see your total net profit, net loss, what have you.
Right. So that simplifies so much. And I agree 100% that you have good, better, best, right?
Mm-hmm.
So you can have a bank account in, let's look at the rental side. So you can have a bank account in your holding LLC, your Wyoming Holding LLC, and you can have your rents being received through the holding LLC, because we have to remember, we have to have somewhere or a name or something that we have a lease agreement with, right? So we have to have a lease agreement with our tenant, and we have to have somewhere the tenant is paying the rents to. And you can do that in your Wyoming Holding LLC. You can do that if you have a C corporation acting as a property management corporation, or you can have a bank account for each one of your LLCs and have the rents going directly to your LLCs. There isn't a right answer. It's just what's right for you. If you have so many properties, so many LLCs, that it would actually be a burden on you to have a bank account for each and every single LLC, then let's do it. Let's go ahead and do the bank account and the lease agreement with your holding, or let's do that with, or set up a C corporation for your property management. Or likewise with the flipping, those are short-term things, right? So the hope is, if we're doing this right, we're not going to hold this property for more than a year's period. So opening bank accounts for each and every one of those might not be practical. But you also have to think about, when you close on that property, where are the funds going to be paid to, and where will your closing company pay the funds to, right? Because you have third parties involved in this, and you have to make sure that the way you're running your business is going to work with the third parties that you're working with, right? We all know this, especially when it comes to flipping, and we're working with maybe a hard money lender or any other type of lender. We can do shelf LLCs at Anderson. And at Anderson, what that means is we have not seasoned LLCs. We have LLCs that we formed with the state on deck. So if you have a deal and you need to get an LLC right away, we can get you a Wyoming LLC right away. However, if you're dealing with a hard money lender and they want you to have the LLC set up in the state that you're doing the deal in, well, we're going to have to form file that LLC in the state that that you're doing the deal in. We can do that, but we have to remember, when we're structuring these things, whether it's flipping, whether it's rentals, we do have to think about those third-party relationships, unless you're buying these properties with cash, of course. The last one I wanted to touch on before we wrap it up for today is wholesaling. We have a lot of clients that do wholesaling that we see. And one of the issues that we come up against sometimes is a buyer who is not willing to do an assignment of the contract, right?
Yes, if they're not willing to assign the contract over into the limited liability company that we usually use for asset protection, then you can go ahead and just, instead of taking the contract, you can just sell the whole LLC as one method. And that way you can still report the gains to your C corporation to take advantage of your tax benefits there.
Yeah, and sometimes it's actually even written into the contract that you're not allowed to do an assignment. Mm-hmm. So one thing that we like to offer is the wholesale trust. So basically what you're doing is you're going out, right, as a wholesaler, and you're identifying a great deal. But you don't want to do the improvement or holding of the property yourself. You're identifying a good deal, and you're going out and sourcing your book of contractors and owners or investors that would want to take that deal. So you put the property under contract, and you take your due diligence period, which is about 15 days, and you find that buyer for the property, that investor for the property. Sometimes the contract actually says you can't assign it. So what we do is we take the wholesale trust. So you're just taking these wholesale trusts, and you're putting the property under contract in the trust. And then you're assigning that beneficial interest to a corporation. And then you can sell that property. Then you can go ahead and assign the rights to that contract over to a different individual, and the contract name never changed. It's still under the name of the wholesale trust. And we can kind of go on a little bit about that, but I do want to see if you guys have something you wanted to add to the wholesale trust portion, even though that the wholesale trust is kind of, or the wholesaling and wholesale trust kind of straightforward. This is the way you avoid, using a wholesale trust is the way you avoid the seller being able to restrict your right to assign the contract. And it's a way to avoid the costs and paperwork associated with having to do a double close, is using the wholesale trust.
I think you got it covered.
Yeah.
I'm that good, folks.
That's why they call it Toni Talks, not Troy Talks, right?
Troy Talks today. But no, I thank you guys so much for joining me today. And I thank you guys for joining me today. If you'd like to have a conversation with either of these guys about anything we talked about today, go ahead and give us a call and we'll schedule a consult.